Hi, everyone. This is Fred Soroka with Golden Gate University. I just finished teaching the first semester of Choice of Entity, where we applied the new tax law, the Tax Cuts and Jobs Act that was passed in December of 2017. The dramatic change in corporate tax rates, dropping from 35% down to 21%, has got a lot of clients taking a look at their flow-through structures and wondering if maybe they wouldn't be better taking some, maybe even all of their structures over into C Corps. The application of the new law isn't clear yet. The area, though, that probably is most challenging for our faculty, certainly for me, was the international area. Happily, I was able to persuade Don Rath. Don, you've been connected with the university for many years. You've presented at our leadership series. Mm-hmm. You're an alum, right?
I am.
And more importantly, you've been involved with TEI at multiple levels.
Absolutely.
And are the VP Tax at Synopsys.
Yes.
I had actually recorded the update for our international tax class. It took me 45 minutes. To be honest, it wasn't quite as clear as what Don managed to do in 20 minutes. Don, could I ask a favor of you? Could you walk our alumni through how you presented, how you're viewing these international changes and how they might affect the structures of U.S. corporations?
Certainly, be happy to. And thank you once again. Fred always flatters me by telling me how well I do in these types of discussions, and it's always a real compliment.
The alternative would be to pay you.
Well, I guess. Yes, there is that. Okay, and I'd like to just start off by saying that as a tax professional, which I've been, one for a number of decades, I have never felt this amount of stress in the system. And when I say that, I mean not just me personally, but this is a real moment within the U.S. Tax industry where we have big sea changes in terms of the way corporations are taxed, and particularly international taxation, and so little guidance and so much uncertainty in the air. And I think the big challenge of folks in my role is that you have to make some big decisions in a fairly short period of time without a lot of information. We all do that as tax professionals every day, but I think, instead of being this big, it is now kind of this big. So what you're going to hear from my comments isn't, the grains of truth and the one right answer. It's really kind of the thought process that myself and other companies are going through in terms of trying to make these big decisions and really sort of solve for the best interests of our companies.
At the same time, Don, you've listened to many different advisors, right? Because law firms and accounting firms are all weighing in, saying this could be an issue,
Sure.
that could be an opportunity. Mm-hmm. And so it was the synthesis of all of that to what do we know, where can we act, where are we unsure? That's really what I think our listeners will want to hear about.
Okay, sure. I'm happy to provide that perspective. So, I think maybe to just frame the issue, I'm going to talk a little bit about kind of the more critical decisions that my company and other companies are going through at the moment, and really kind of take it from the perspective of not just, what's the right tax answer, but what is our management thinking about, what is our board thinking about, what are we hearing from our investors and the analysts that cover our companies. And talk a little bit about some of the choices we have, not just solely in terms of the choice of entity, but kind of broader decisions we're trying to make in this process. And it's very much a synthesis of limited guidance, seasoned perspective of a number of advisors. And what makes it kind of fun, if there's a fun part to this, it's the interactions that have happened within my team of people in terms of really focusing and trying to solve some of these problems over the last few months. So I'm going to take you to what I think is a fairly standard kind of pre-tax reform structure for technology companies with significant international operations, which Synopsys happens to be one of. I think the goals historically is that given we operate under a deferral system, we obviously want to minimize our U.S. tax burden. One way we've done that is to move the rights to our IP in foreign markets offshore to take advantage of lower tax rates, but also to marry that up with our global business structure. So the classic model is that you want to be close to your customers, you want to contract and fill orders outside the U.S., you want to be able to support those customers in a closer fashion. And so you marry up your tax structure with that, and you find yourself that you can actually create a system where you're taking advantage of lower rates than the U.S. rate. But the big price tag you pay for that is you have a lot of trapped earnings offshore. And the biggest challenge for technology companies has been to fund their global operations with limited access to that foreign cash. That has been a big pain point for many, many years, and it's one where the new Tax Act provides some, sizable relief.
And that's actually one of the major drivers, right, was to drop the U.S. tax rate so we are more competitive, and then remove the barriers to returning money back to the United States.
That's right, the barriers, and also create a new set of incentives, because as we'll see, they've put some interesting provisions in place that try to somewhat neutralize the decision as to whether you hold your IP offshore or you hold it in the U.S., and how do you kind of equalize for those concerns. But certainly an improvement from the perspective of avoiding that constant problem of how do I access my foreign profits in a way that makes sense to invest in the business. So the reset button, as I call it, is the transition structure that was created by the TCJA, in which there is a one-time taxation of accumulated foreign earnings at a favorable rate, and with a partial credit for the foreign taxes paid on those earnings. With that, you get pretty much unfettered access to your legacy offshore cash. And then there is a conversion from the deferral system to a territorial system, so that you're no longer going to be burdened by a second level of tax in the U.S. when you bring future earnings back home. So a real sea change in the way we've taxed international profits historically.
So basically, all these American companies that were leaving their income offshore, we have to compute a tax in 2017, 8%, maybe 15.5%, depending on if it's businessy or not, but we get to pay it out over 8 years.
That's right.
So good news, it isn't a huge cash burden right now. And then after that, since now you've kind of fessed up on all your deferred earnings, now we switch over to the new system starting in 2018.
That's right. And I think in a classic territorial system, what we would see is that foreign earnings would have tax at the local level, the foreign tax paid, and there would be little, if any, U.S. tax, residual U.S. tax on those earnings. We've kind of created something a little bit different, as we'll get into, that provides some swim lanes, as I call them, to prevent companies from taking too much advantage of lower rates. Even with the lower U.S. rate, there are still better deals to be had, if you will, from a tax rate perspective. So they put some rules in place to mitigate some of that risk.
And this is where we launch into all the acronyms, if I remember correctly.
Yeah. So it is an opportunity to sort of look at different structures. And this is where I'm referring to lots of conversations I've had with my peers in industry. One option is you just maintain the status quo. You now sort of have better access to what was used to be part of a deferral structure. You can continue to operate in that way, but you may have some residual U.S. tax as a result of that. You could simplify your structure. One of the things we talked about in Fred's class is that you can make elections or restructure your foreign operations in a way where it's a bit more streamlined. And that may provide a simpler model if you choose to continue to hold your IP and conduct business activities offshore. And then kind of the biggest or most radical change would be to convert to a disregarded entity structure, where you essentially convert everything under the U.S. parent to a branch, so that all of the income is taxable in the U.S., potentially with credits for the foreign taxes that you're still going to pay, but with some incentives to potentially have some of that foreign profit also taxed at a favorable U.S. rate. So there's many flavors of these three options, but these are kind of the fundamental choices of structure that most of my peer companies are considering now.
Got it. So if I had to go through, status quo means what we have is lots of corporations that kind of bottle things up, make us worry about things like Subpart F, but kept our income away from the U.S. Mm-hmm. Your single CFC, what you're suggesting is you can get rid of all of the lower tier foreign entities, make them flow-through entities, still operating the same under
Sure.
the local jurisdiction. Or you can go all the way and say, let's make everything a flow-through coming into the U.S. corporate tax return, which would be, sounds like it would have a terrifying tax associated with it, but the advantage of having foreign earnings escape tax is you can probably do that without a huge U.S. tax burden.
Sure. Terrifying tax, but also, avoidance of some even more terrifying taxes and potentially some benefits, which we'll get into in a second.
Cool.
So those cool acronyms you were referring to, and I have to give the lawmakers in the Senate full credit for coming up with a clever system of acronyms that sort of speak to some of their concerns from a policy perspective. You don't, hear words like guilty and beat that often in a tax context, but they've actually created, sets of laws around these things. And these are the swim lanes, to describe them nicely, that I was referring to earlier. Guilty, I would sort of refer to that as the stick. That stands for Global Intangible Low Taxed Income. And the principle here is if you're going to maintain some sort of offshore structure, don't get too greedy. There is still, a minimum amount of tax that we feel is appropriate to pay. And if the foreign governments aren't charging that tax, the U.S. system is happy to pick that up. And the way that those rules work is essentially you have an inclusion similar to our Subpart F system of half of those earnings, which sort of gets you, based on the new U.S. rate of 21%, down to a 10.5% rate. You also get a partial credit for the underlying foreign taxes paid, but you can't use more than 80% of your foreign taxes as a credit. And so the way the math works is that as long as you're paying 13% foreign tax overall, you won't have any guilty. But if you drop below the 13% rate on the foreign side, you're going to have some sort of pickup, most likely on the U.S. side.
Got it. So if all I have is a bunch of CFCs, I keep my old structure. Good news, I'm paying tax at 21% in the U.S., which is lower than it would have been. But on my foreign stuff, I can just pay the foreign tax to the extent that I've got sufficient foreign taxes to reach a 13% effective tax rate on that stuff, because 80% of those will offset the 10.5. But if I paid no foreign tax, the worst that I've got is 21% on my domestic and 10.5% on my foreign.
That's exactly it.
Cool. Okay.
Yeah. But the linchpin there is that it's the 10.5% on the U.S. side that you're paying on your foreign earnings, which is sort of the deviation from the classic territorial system. And this is, again, policy-driven.
That's the stick.
Yeah. And then, there's the carrot, which is something we call FDII, or Foreign-Derived Intangible Income. I tend to think of it as the kind of the distant cousin of guilty. Because the way those rules work is if you earn your foreign profits in the U.S., those profits are in the U.S. system, you actually get a deduction against those profits that lowers your 21% rate down to a 13% rate. So you can see what they've done is kind of taken some of the incentives to keep foreign profits offshore because, as we saw in the guilty model, you're going to end up paying 13% tax to avoid guilty, or you could pay 13% tax in the U.S. So it takes some of the decision-making out, if you will. If your foreign rates are going to be 13% or better anyway, the incentive is maybe you should move that IP to the U.S. where you're going to, basically suffer no more than the equivalent amount of tax.
And somewhere between guilty and FDII, at least, we no longer have that really strong incentive coming from the U.S. government to push all our foreign intellectual property offshore.
That's right, and that's exactly the policy underpinning for this. Let's sort of tax neutralize that decision making and let folks do that based on economics rather than tax. So that could be a good outcome. Now, I've oversimplified the math around this. The rules are far less than clear, mainly because they really haven't been written yet. But, just kind of rough math and the high-level analysis that myself and others of my peers have done. This is kind of the decision we're going through, which is sort of the longer-term path. Can we live with guilty, or do we want to take advantage of FDII?
And when you described it to my class, you explained that you kind of know what your U.S. earnings are. You've been doing studies to figure out how much you're making in the rest of the world. And if you think of a blended rate somewhere north of 13% on your foreign earnings and 21% on your U.S. earnings, you've got a blended rate somewhere in the high teens, which actually, that's pretty nice compared to what we've been living with over the past few years.
Sure, sure. And, you still have R&D credit in place. You still have some other U.S. incentives in place that might potentially bring your U.S. rate down as well. So you might even get better than that blended teens rate. So you have the carrot, the stick, and what I would call the club, which is BEAT. That's a joke, by the way. And really, what it's just saying is, okay, if the whole system kind of goes nuts, we want to ensure that there is still an overall minimum level of taxation in the U.S. and that you're not using gamespersonship, if that's a word, to sort of inappropriately lower your overall U.S. tax burden. So they came up with something that looks a lot like the alternative minimum tax, except you never get a credit for it. But what it basically says, if you take your U.S. taxable income, whatever that turns out to be, after FDII or GILTI or both, and you add back your payments to related parties, other than cost of goods, you take that new tax base and you multiply it times 10%, and to the extent that exceeds your regular tax liability, you have an add-on tax. So this sort of forces you into a situation where you could end up with an effective rate of 10% on everything, U.S., foreign, whatever, without regard to the base erosion that you've done to create that.
Got it. So blended rate in the teens, but BEAT says no matter what, you're never going to get below 10% overall, right?
Right. And then again, that is after adding back all your payments to related parties.
Don, this is really helpful. I'd point out that we don't know what the law means. We need technical corrections. We need clarification from Treasury. But we still have some arguments with the Europeans, don't we, on whether or not this is going to be considered
absolutely
illegal state aid?
Yes, and one of the big bets where you make if you decide to move your IP to the U.S. is, first of all, is the 21% rate going to last? There is political risk that that changes over time. But more importantly, if your primary incentive is to lower that 21% rate to 13, you've got to worry about what the WTO or the EU or some combination of both will do. There is a point of view that, like some of the prior sort of export incentives we've seen in the U.S. system before, like FISC and ETI. The FDII could be considered an illegal export subsidy. There will likely be some sort of challenge around that. I think the counter argument is, kind of what I was referring to earlier. It's not a specific, subsidy. It is sort of the equalizer to the GILTI, which is essentially a base eroding measure. So they're trying to position it differently, but there's definitely that risk. And if, like some of these prior incentives, it's found to be an illegal export subsidy or otherwise non-compliant, then you could be back up to 21% on your foreign profit. And so that's tough, right? That's a big gamble to make. And some of the analysis we've had to do internally is to really kind of stress test our models to say, well, what if 13% only lasts for 4 more years or 8 more years? And what is the risk of other forms of retaliation by foreign governments who may not like what they see in terms of what the U.S. is doing to change the taxation of those profits?
Got it. And no matter what, we know that you representing a multinational corporation, you need to be thinking about the changes that are going on in different countries right now.
Sure.
With the Europeans talking about maybe shifting over more towards a sales-based tax on any digital goods, things like that.
Absolutely.
And similar pressure coming from Asia. And what used to be a simple world of having cost-plus subs gets pretty darn complicated, right?
Yeah. And it's interesting because U.S. tax reform is coming into play at a timing when companies like ours are already dealing with some big issues around OECD and the base erosion, profit shifting, or BEPS set of rules. We were already looking at changes to our offshore structures independent of U.S. tax reform, with a view toward how do you make those less risky and more compliant. And there was definitely going to be pressure on lower rates of foreign tax as a result of those changes. I mean, under the BEPS rules, you can't get to a 0% rate very easily anymore on anything. Putting things in islands and hoping that a 0% rate will be sustained solely based on distribution of contractual risk doesn't kind of cut it anymore. BEPS has really changed that. So it's interesting at a time when we're already looking at how do we modify our foreign structures and therefore modify our IP holdings. In comes U.S. tax reform that creates an alternative. Maybe it does make sense to move it back to the U.S. where you don't have to worry about how much substance you have overseas and how foreign governments are going to view that.
Got it. And BEAT is really the American version of BEPS, was my impression, saying that we don't want to have nowhere income, zero taxed income.
Yeah. And again, this overall sense that, we're kind of giving multinational companies a better deal, but, we want to ensure that there is nonetheless a sustainable base. I mean, it's as much about the money as the policy.
Wonderful.
Yeah. So, what do you do with all that? Well, going back to our three kind of straw person alternatives, again, depending on what structure you ultimately go with, you're going to have higher or lower susceptibility to, FDII and GILTI and BEAT and all those things. You sort of take your classic, historic structure. You could, conceivably get to a fairly low foreign rate, but, you're going to have very high GILTI risk. And your challenge is going to also be, just based on the way the math works around GILTI, if you're paying foreign taxes, how do you optimize that? How do you at least get as much credit as you can for the foreign taxes that you're going to have to pay? It's kind of interesting because, Subpart F used to be a kind of a four-letter word in our business, and when you compare it to GILTI, it's actually not such a bad deal. It's got very much a change in thinking, and so I know some of the planning that not my company but others are engaged in is, well, can you structure in a way where you're sort of generating Subpart F income in some of your higher tax jurisdictions, but at the same time trying to keep your GILTI risk as low as you can. So there's certainly planning being thought of around that. Again,
because the U.S. taxes that Subpart F income in the CFCs, at least you only pay 21%, not 35%, right? So It isn't as bad as it used to be. It might be. Yeah,
and you don't have the same limitations of associated credits, so it's not too bad a deal as long as you can again control the GILTI part.
Okay.
The simplified structure. That really, will be of interest if you're going to, kind of stick with the offshore model, but, you want sort of less GILTI risk. So, there's rules in the law around, what you get credit for in terms of your GILTI calculation. GILTI is measured by the excess of your profit over a 10% return on your tangible assets. And some of the underlying entities, some of them may have profits, some of them may have losses. A check-the-box kind of structure gives you an opportunity to, perhaps get a better answer in terms of what your tangible asset base is.
You can add all your tangible stuff together, right? And
right.
test it against your overall income netted against losses.
Right. So you're not losing that base, if you will, just based on the way your foreign profits are distributed.
Got it. So the first, we don't really change our structure. The second, we don't change our international structure. We just change what the entities are for U.S. tax purposes.
Right. Exactly. And then, there's sort of the bet the farm on the lower U.S. rates and FDII lasting, which says, maybe you should have one single check structure. So you don't have an offshore structure. Everything is, in effect, in the U.S. system. That eliminates the GILTI risk because, there's nothing to be guilty about. There's very low BEAT risk because your, related party payments are going to be disregarded. So they're effectively zero. And you potentially get FDII benefit on the foreign profit. There are some, interesting and currently unclear issues around, the branch rules. and ultimately how that profit's measured. But I think there's a sense that if all things work as intended, you could get to a very good answer with a very streamlined structure.
Because your domestic income, again, you're paying 21 cents on the dollar, and your
Right.
foreign income with the FDII benefit, maybe you're just paying the 13 cents.
Right, and no risk, virtually no risk around these add-on taxes.
Except for the fact that Congress may increase the tax rates next year.
Yeah, and I think with that, you are locking in to a U.S.-based structure. Decades ago, folks moved IP out of the U.S. There were ways to do that although, the IRS challenged them, weren't as expensive as they would be to make those same moves today. So you're kind of stuck with your IP in the U.S., and the risk here is that you're going to have to, think about how that changes your benefits if there are changes in the U.S. rates, if FDII goes away, if other things don't operate in the way that you expected them to, and that's sort of the big stress factor that we're all facing is, fiscal year companies like ours have a short window within which to make some of these changes without running a guilty risk around our IP restructuring. That game is up at the end of our current fiscal year. So you've got to make these choices with very little guidance, and taking into account the fact that these rules may not work out the way that you plan them to.
Wonderful, thank you. No, that's a very clear explanation of the decisions that we have to make. And this is just from a tax perspective.
Absolutely.
But you look at this a little bit more broadly, right?
Yeah, and you really have to, because you don't own this pot of money, right? This is ultimately a problem you're trying to solve for the benefit of your company and its shareholders. And I can sort of make my own calls on some of the technical risks. I've got good advisors that help with us with that. I've got peers that are willing to give me their input on things. But you also have to look at the world outside of tax and say, okay, what's our management going to be worried about? What's our board going to be focused on? And how do we kind of explain all this stuff to our investors? So this is a very simple framework to address some of the considerations of all those stakeholders. Our management is certainly focused on uncertainty and lack of guidance. That they make business decisions every day, with a certain amount of uncertainty. But, taxes is already kind of an unknown. And to say it's an unknown without any well-understood rules at this point isn't kind of what they want to hear. And so one thing, we've had to get them very comfortable with is that we've considered changes in our structure. We have to take into account, the risk of U.S. law changing, the risk of foreign retaliation, for lack of a better term, whether it's WTO or something else, and how do we sort of balance those risks in terms of what might seem the right answer on paper. I think that's about as well as I can describe it, and it really is involving educating management around some of the risks and uncertainties of tax that they never really kind of had to understand before. And they're very complex conversations, and they're ones that you have with relatively little authority. It's sort of Don's view of the world based on the best information I have today, which ain't a lot. But that is certainly the biggest challenge, and management wants to make the right decisions, but they are also recognizing that there's a lot of risk to the choices we're making. The opportunity, though, is we could ultimately get to something that is much simpler not only to understand but also to operate. Today, we go through all sorts of hoops to sort of preserve the integrity of our offshore structure. We make our customers sometimes, sign contracts with 7 different legal entities, and we're already kind of known as a company that is often tough to do business with, and to sort of add that to the mix isn't very helpful. So, depending on how you structure your IP, you can kind of eliminate some of those hoops and really, present a much simpler, structure. And, the other opportunity is if you could really get confident that 13% rate on foreign profits would last, that's a really big benefit. That provides cash flow and earnings to reinvest in a way that we haven't had in decades, because we don't have constraints around use of the offshore cash, and you have a very favorable overall financial result with it.
So rather than just view it as I'm in charge of the tax cost center and I'm managing my effective rate, you're really thinking about, can we be nicer to our customers? Can we help the company grow, better utilize all the resources we've got
Sure.
stuck away in different pockets?
Absolutely.
It's a great view of
Yeah.
how you help management make better decisions.
Yeah, yeah, and it is also helpful in those discussions, because if I was just having a discussion about how risky everything was and I don't really know the answers, it's not terribly productive. If you can kind of position the conversation and the choices we make in a way that, takes advantage of opportunities to make our business simpler and our customer experience better, I think the risk tolerance goes up. People sort of say, well, this is a business opportunity, and like any other business opportunity, there are risks attached to that. They happen to be tax risks in this case, as opposed to other risks that our management deals with. But same kind of thinking.
Very cool.
Yeah. So that's management. The board is also very much engaged in these conversations because, again, we are making big decisions. Ultimately, those decisions will have significant consequences to our shareholders because, they directly impact our stock price. Again, I think they have similar concerns to management. The one thing I hear is they understand that we have this relatively short window to make some choices regarding how we structure our IP. They are not as comfortable as they would like to be in terms of having to make sort of short-term decisions on longer-term issues, again, with relatively little information. But they also sort of get the fact that there is an opportunity cost to waiting. And I think that's the most significant part of the conversation we've had and some of my peers have had. Yes, it is risky, it feels uncomfortable, but, we don't get this opportunity again. If you're going to move IP, back to the U.S. in a certain way, with a view toward capturing, the benefit of some of these incentives, you're going to do that in a way where there's going to be a lot of unknowns. But it's not like you can just sort of make the decision next year.
And that reputational risk, we've seen American companies get bludgeoned by foreign governments just by going through the media, right?
Sure.
Saying, yes, they're paying the tax that our laws require them to pay, but we think they should pay more.
Mm-hmm.
And so protecting the company against that kind of attack is something I could see as being a really important factor in deciding what is our structure going forward, how important is saving a couple of cents on our effective rate.
Yeah, absolutely. And I think taking some of the reputational risk off the table is kind of one of the big opportunities our board and other boards will see. When you have companies in Bermuda that don't have any employees, when you have some fairly complex structures that people don't really understand, and sometimes those things get out into the public domain, and it's kind of uncomfortable. And you really do have to worry about public perception, because that includes, customer perception. In some companies, customers includes governments, and it just sort of clouds the way the company is viewed. If you have something where you switch to a model that says, okay, my IP is in the U.S., my management is in the U.S., most of my decision making is in the U.S., it kind of looks better, and it's not viewed as some kind of strange animal that's out there to serve some suspect purpose. I mean, that's kind of the way I would think about it. I think the other thing that is really valuable is if you sort of take some of the tax complexity out of the structuring, people start focusing more on the fundamentals of the business. One of the challenges we've had, I mentioned earlier, is, kind of what we and other multinationals do because we can't access foreign cash. And, you sort of pick up, a company's financials and you see huge cash balances and you see huge debt balances and you're trying to make sense of that. And the tax is very much central to why you see some of the results you see. You sort of take away the incentives to behave in that way. You take away, some of the need for the complexity. You can sort of strip out sort of the tax cloudiness and focus more on how the company operates.
Got it. So maybe you could save another $1 or $2 here and there. It's certainly worth looking at.
Yeah.
But you got to balance that against how much it costs you to run these big, complicated businesses.
Sure. And I think also, I think tax becomes a little bit more transparent. which I think is a good thing as well.
With this new country-by-country reporting, it's kind of required, I
Yeah.
guess.
Maybe turn a second to investors, because they ultimately kind of hold a lot of the cards here. I think short term they are, and I'm talking about the analysts that cover us when I say investors, but they are frustrated by their inability to model reliably. I think the drop in the U.S. domestic rate from 21 or 35 to 21, that's math everybody gets. You can sort of figure out from published financials how much of your business is outside of the U.S., and everyone sort of can do that math and figure out the drop in the rate that happens, in your first year out. What they don't get is sort of the future, and that's partly on us because we haven't figured it out yet, and partly on us because we don't have any clear rules, right?
Right.
So I think investors, want guidance for the future, and we're not terribly well equipped to give it to them at this point. We can give them ranges. To share a short story, I mean, our reported rate in my company up until tax reform has been 19% worldwide effective rate. When we dropped the U.S. rate from 35 to 21, and half of our business is outside the U.S. Big surprise, the rate went down from 19 to 13. But we said, we can't really give you guidance on the future because there's a lot of sort of bad stuff that hasn't kicked in yet, and we have decision making to do around how we're going to operate, going forward. So what do folks do? We're not going to give them guidance, so they're going to assume it's somewhere in the middle, right? And now there's a data point out there, and the stress in the system is, well, are you going to land on that data point, or are you going to land higher, or are you going to land lower?
We know what they're going to do, add them together and divide by 2, right?
Well, that's exactly it. And but I think that lack of guidance can't last forever. I mean, companies are going to have to close out these decisions and at least have a reasonable range of outcomes to offer investors, in fairly short order.
Although when you think of it, the engineering department is willing to take risk and say, I think I can build this. The marketing department is willing to take risks saying, I think I can sell this. We tax professionals have been really reluctant to make any statements if we didn't have a citation. Mm-hmm. And the answer is, in an uncertain world, you got to be willing to guess.
Yeah, there's nothing to cite. So, but I think the opportunity is again similar to the decision making on the management side is people will view the company in a more tax neutral fashion. They're not going to have to worry about how much of the what they're seeing in the earnings as a result of tax stuff, whether it's one-time settlements or law changes or risks. You could really get down to something that is a lot more predictable, which I think again will sort of take kind of one less variable out of the equation and sort of focus on the pre-tax performance of the company more. So there certainly is an opportunity once we're sort of past this difficult period of uncertainty that the guidance can be of higher quality and the analysis on the investor side can be focused on more business fundamentals.
Don, this is really helpful. I come from a Big Four background, and my friends who are still in public accounting and law focus so heavily on the technical and what can I do with respect to the tax rate. And what you're suggesting is the advisor should be thinking in other dimensions also, right? Because you, as a VP tax, you're making decisions, taking into consideration what does my management think, what does my board think, what do my investors think, what do my customers think?
Mm-hmm. Yeah, and it's a great point because, again, the advisors have no better information than I do at this point. Because the law is unclear and we haven't worked up a body of regulations and authority around it. So the best thing they can do for me is to help me think through some of these risks and variables and how I explain them to my management and my board, and with that bring in the experience they're seeing in other organizations that are going through the same kind of decision making. So that's my plug for the advisor community today.
Wonderful, thank you. If I had to guess, I'd say that pretty much covers everything that our alumni might want to know. As we take a look forward, do you have any guesses? Is 21% going to hold? I think Ronald Reagan managed to get individual rates down finally to where capital gains and ordinary income were exactly the same. Might have been 1988. I was already practicing. And I think it lasted for all of 12 months, if I remember correctly.
Yeah. Well, my crystal ball is no better than anyone else's. Just from what I've observed, I mean, the 21% rate, I don't know, rates don't sort of change easily. Or, I don't think we'll ever be back up to 35 again. I think there's been sort of, one proposal floated, to bring them back up to 25, shortly after the ink was dry on the 21. But I think where we're likely to see more change and, maybe more volatility is in the application of some of the foreign rules. And, advisors are very clever people. There may be, workarounds to some of the more burdensome parts of these rules that, are viewed as, abusive or not consistent with the policy underpinning the reforms. And that's where we'll probably see pressure.
Interesting. So I would have said that, gee, from November 2 through about December 10, we were at a 20% corporate rate. So we've already lost 1% just in the month that it took to finalize the statute.
Right, yeah. Once you get it
my gut's
finalized.
telling me 23 might be a good number to take a look at in the future. But again, we're just looking in a crystal ball and guessing, right?
That's right. That's right.
Don, thank you so much for this.
You're quite
Really
welcome.
appreciate
Thank
it.
you.